Let's do it, folks. Good morning, one and all. Welcome to the street today here from Post 35 on the floor of the New York Stock Exchange. Today is Monday, February 13th, Valentine's Day Eve, I guess. I don't know. I'm JD Dirk, and we're about an hour or so into the trading. Stocks are in the green as investors look ahead to tomorrow's CPI report and a lot of corporate earnings coming up later on in the week. Yes, earnings palooza continues. On the show this morning, let's talk about what's on tap for this morning's broadcast. We will be previewing the January CPI report that is set for release tomorrow. We'll also talk about the Fed's next move and the possibility of another 25 bips. And finally, we'll tell you why Meta is preparing for, yes, another round of layoffs. For more on those stories and so much more, we now bring in our special guest on this Monday morning, Christian Hoffmann. Christian is portfolio manager at Thornburg Investment Management. He joins me now. Hey, Christian, good morning.
Good morning.
Great to have you here. So a big week ahead of us, of course. You are a fixed income investor. So I wonder, what are some of the main economic indicators that you have your eye on, that you're following for a week like this?
This week is all about CPI. I think, last week there wasn't a lot of important data. The jobs report, I think, has really reset this market. And again, everyone's glance has shifted towards CPI. That said, I really feel like this number is de-risked. While incredibly important, the fact that the market and the Fed are more aligned on the expectations path and, really aligned with that more work needs to be done, I think means that even if we get a hot number, that the market isn't going to react too poorly to that. And if we get a number that's a little bit softer, that feels a little bit better, I think, we could rally on that too.
Is there, what do you consider a hot number? What number should people be on the lookout for, if that's something that you are already kind of paying attention to?
I mean, I think, something high six, even into the sevens. The composition is going to matter a lot too. We've seen with Manheim that, used car prices are creeping up again. And again, it's also going to be relative to positioning and expectations. But really, we need to keep an eye on wages, because I think, that's the thing that's more sticky. That's the thing that the Fed really has their eye on. And, if the job market continues to appear hot, and I think there's some danger in that, it might actually be looking hotter than it actually is. Again, it's a little bit of a disconnect where we see a super hot jobs number, record low employment, but every single day we have these news flashes of, companies cutting jobs and, consumer behavior normalizing. That's a bit of a disconnect and something I worry about the market mispricing.
Yeah, we follow consumer spending a lot. A lot of these companies, and we'll get into it here in just a bit, of course, that are engaged with layoffs tend to be tech companies, finance companies, media companies, leaving some to wonder if it's more of a tech session or a rich session as opposed to a traditional recession. But again, we're all eagerly looking through the data. We love data here, folks, right, Christian? I know you do too. The U.S. bond market posted roughly a 13% loss last year. You're the perfect person to talk to about this. Are you expecting conditions to improve a bit here in the new year?
Absolutely. We've long said that, 2022 was a reset year and really set up for good potential total returns in 2023. Some of that played out very early and very quickly, as we saw a very strong January performance. That said, if you didn't have your fixed income allocation on in the way you might have imagined, I don't think you've missed it. There's still time. I think, there's going to be volatility along the way. And I even look for moments like this where, you see, higher core rates to increase the duration in your portfolio. If you go back to 1994, that's one of the last really horrific years you saw in fixed income. The ag was only down not even 3% this year, again, relative to the 13 that you mentioned. 1995 was an incredible year for fixed income. I don't know if we'll have a repeat performance of that, but again, I think we could easily post double-digit returns when you have, a nice coupon and potential tightening. But at the very least, not only do you have a good potential for total return, but I think also ballast in your portfolio and that traditional role that people looked for in fixed income, which really didn't work in 2022.
Bond yields, of course, have been flashing recession signals for quite some time. There are some who wondered if there are distortions in the bond market, given all of the money that the Fed added to its balance sheet going back to 2020. They are sitting there now in this era of and sitting and saying, okay, well, maybe the traditional recession indicators are skewed a little bit because of all the mortgage-backed securities and other instruments the Fed had to gobble up in 2020 and 2021. Any chance you think here we're already in recession territory and may just not know it yet? And do you similarly think, as some do, that maybe we cannot take these traditional indicators on the surface, given the era of QE?
Well, anytime someone says this time it's different, that causes a visceral reaction in my body where I recoil. I think there's certainly, that's worth exploring and thinking about. But usually it's not. And again, you talked about kind of unprecedented monetary and fiscal, policy for the last, 2+ years. I'd actually zoom in, to the time period from really 2008 forward. So we're talking about, 15 years where the Federal Reserve started spiking the punch bowl. And it's really in the last, 2 odd years where they took away the punch. And it was really just, straight alcohol going to the market. That inflated, thousands of tiny bubbles. And we're seeing them really pop one by one. Interestingly, a lot of times there's a catalyst, there's a Lehman moment, which, pops all the bubbles at once. We haven't had that yet, even though, there's certainly been cases and evidence where that could have happened. But we're still seeing excess being wrung out of the market. We're still seeing, tiny bubbles pop. And again, I think it's still going to be a choppy year, and investors need to be paying attention and not get too complacent.
Christian, let's dive into CPI a little bit more. We talked about it a few moments ago. That report, of course, is due out tomorrow. Talk to me about some of the other main factors of the report that you'll be paying attention to, and especially for people that maybe like me had a few days off the weekend. They're coming in and saying, "Oh yeah, right, CPI is Tuesday. I should probably be paying attention to it." What would you tell that person to most closely focus on?
Yeah, again, I think jobs, again, has de-risked that number. That, setting up to it, it could have been a huge market catalyst. One of the other things you need to pay attention in the market this year is it's really been driven by positioning a lot and actually mispositioning. So this has been a pretty hated rally broadly. If, the voices were pretty uniformly bearish and skeptical. And people were short, they had a lot of cash, they didn't have a lot of risk on. And so when things started to run, people started to chase that, to put risk on, to deploy cash. And that created momentum to the upside. But it wasn't something I would say that was, broad-based in terms of belief, and that, things feel really good, and that, valuations were cheap. And I think, some of that has been wrung out. We're probably a bit more neutral, even though, again, the bull case is pretty quiet, still into the marketplace. But that said, again, some of the repositioning that we've seen in the market, again, especially since that job number, means I think we could actually, rally in either case, despite how it comes out. You talked about more data and things that we should be thinking about and paying attention to. Again, I think we have to be laser focused on the job market, and the health or lack thereof, broadly, across, jobs and wages. I think the other thing to think about is, does the Fed really have this headroom to hike policy, and is this risk of a policy mistake still on the table? That was something that was very much a part of the conversation, but has kind of receded into the background, and I think that's a mistake. I think we need to keep having that conversation, and do we risk overshooting?
The last time we heard from Chairman Powell, I don't mean his public remarks last week, but at least at the last FOMC meeting, Christian, he used the word disinflation 13 different times, either between his prepared remarks or the question and answer that he does. And so it's certainly indicating that it's something that he's paying attention to, and it's a different rhetoric than we've heard for quite some time, right? So that's at least, I almost said the word pivot, but I'm not going to say the word pivot because it means something different in our other context here. How do you think we should view the overall picture of disinflation that Powell has been touting and openly talking about, at least with a bit more confidence as of late? But keep it in mind that he's also been very clear to say there will be ongoing rate increases. And people are sitting there saying, yeah, probably this terminal rate is higher and it will be there for longer than at least many investors had been hoping.
Yeah, most of the cuts have been priced out of the market at this point, and I think that's interesting. I think there's an interesting intellectual argument as well that those cuts necessarily weren't priced in, but it was a small probability of actually having large cuts. And it filtered in, and people saying, oh, the market's expecting this, but maybe it was actually, 80% people, expected no cuts, but 20% they actually expected a pretty hard landing and a strong reaction to that. Right now, again, Valentine's Day is coming up. The market and the Fed, are getting along. They're listening to each other. They look, much more like a happy couple as opposed to the, dysfunctional couple the last, 6 to 12 months that we saw. It's very interesting. Powell had the chance to double down when he spoke at the Economic Club in Washington. But he did not try to go after markets. He did not try to, scare people. That interview was, incredibly lighthearted. He talked about cycling and almost sounded like there was a laugh track. So I guess the energy in that room was just, fun and jovial. Perhaps, they brought out the punch bowl with the alcohol. I'm not sure, but, things felt pretty lighthearted there.
Roses are red, violets are blue, inflation is high, and rates will be too. That's what I propose that that should be the mutual Valentine's Day greeting back and forth tomorrow between investors and Mr. Powell. Okay, let's talk about the current inflation target. He does say it should be around 2%. We know we're not really close to that. How long do you expect it'll take until we get to that figure, if we get to that figure? Will we get to that figure is, I guess, probably should be the first question.
At some point, the good thing about fixed income investing is that mean reversion works, right? So, unless you have a central bank that's totally irrational and not doing its job, you live in these bands of low interest rates, medium interest rates, and high interest rates. If you take advantage of when interest rates are high to reset your fixed income allocations and to have those on, to have some duration on, over the long term, you will make money, right? Because, eventually you'll head into a medium rate cycle, you'll head into a low rate cycle. The danger is actually getting over your skis when you're in a very low rate cycle. I think we saw, the dangers of that, in 2022. But again, this should be a good chance for people to reset and to look at valuations, to consider real yields, which, are actually compelling for the first time in a very long time, and to really take advantage of this market environment.
I do want to ask you about retail sales, because that will be one of the few data points we follow very closely, including housing starts and things like that. But retail sales will get ahead of the retail companies that'll be reporting the next few weeks into early next month. We've witnessed 2 straight months of declines here, Christian, with regards to retail sales. Do you expect that trend to continue? And if not, what should we be looking for?
Yeah, I'm very cautious on the retail sector. Again, you're seeing it in high frequency data like that. You're also seeing, a number of restructurings. So we've been in a very, in terms of the default cycle, defaults have been very low, but those have been creeping up. And the usual suspects, the weakest links are, kind of the first dominoes to fall. You're seeing a number of retail restructurings. I think you're gonna see that continue. And really, they're kind of getting it from all sides, right? They have the pressures of e-commerce, which is a long-term secular pressure. That part of the job market continues to be, incredibly tight. So it's hard to find labor. When you find, that labor, you have to pay them a lot of money. You have input cost inflation, and then you have really normalization and pressure on consumer balance sheets. So you put all those things together, it's really a toxic mix for retailers. And I think, if you're investing in that space, you need to be pretty cautious and do your homework and make sure that, those companies or that space can actually withstand, a pretty healthy downturn.
Christian, we're still several weeks away from what will be the next FOMC meeting. Many expectations there for another 25 basis points, but it was sort of interesting to have the timing of the last one come out right ahead of that monster jobs report, the 517 figure, to the point that Chairman Powell was even asked last week, well, hey, had you had that data first, would that have changed your calculus for what you and your colleagues did behind closed doors? And he basically says, well, that's not the calendar. That's not the reality we got to play with. But it did kind of make me think, like, oh, had you known the number, would that have influenced what you did? So we at least will have new CPI data before that. How do you think that may or may not impact how the Fed acts at its next policy meeting? And if not CPI, is there other data that you think is going to be really top of mind for Fed officials to take into consideration?
Yeah, I believe it was in one of those speaking engagements where he said, oh, we don't make decisions based on any one data point, but I'd push back against that. I think, the last 6 months, there was plenty of times where, the Fed really looked to one data point and that, made the, really a 25 basis point incremental if they were going to, push harder or, go a bit softer on that. The great thing about these Fed meetings is they tend to decrease volatility in the marketplace. We've generally rallied on the meetings. There were relief rallies. And the Wall Street Journal has gotten in the habit of, telling us what's going to happen. And what I'm really referring to is, the Fed, whispering to a favorite reporter there, and kind of giving us the answer. This is still a Fed that doesn't like to surprise the market, that likes to give lots of advance notice. They try to decrease volatility in the marketplace. On the other side, they still, I think, talk way too much, and you'll have, days where, five Fed speakers are going around the country and giving speeches. I think that creates unnecessary volatility in the market. But in terms of action, they really like to telegraph what's going to happen and almost market test it to the extent that it doesn't, surprise.
Yeah, we were talking about the labor market a bit earlier. The Fed said that the market there still remains historically hot, as we certainly know it does, and that it remains committed to cooling the employment picture. It says that of the Fed. How far off do you think are we from what Fed officials want to hear in terms of job growth? I mean, my goodness, I can't imagine anything remotely close to the 517 figure we got a couple of weeks ago is a step in the right direction. It sounds great, but again, keeping in mind the seemingly counterintuitive goals of the Fed.
Yeah, and I mean, they're happy to have a good job market. That's not really the problem. The problem is, inflation is the front and center risk, and the thing that's become a political problem, and the thing that they're tasked with solving. So, if everyone could have a job and, employment would be very low. Again, you go back and look at some of the speeches from, 2018, 19, and 20, they would have been doing a happy dance with that outcome. But right now, inflation is the bigger problem, relative to the labor market. They actually need to attack the labor market to get those things aligned. The interesting thing about that hot jobs number is that I've seen some theories of what could have skewed it in terms of seasonal adjustments, calendar effects. But one thing I haven't heard anyone, strategists across the street really talk about is, a reason that the economy should be reaccelerating. And that, I think, should be considered, and really risk that maybe that was a bad number, that there was, some junk or bad data into that number. The catalysts that are slowing this economy from wealth destruction to monetary policy to the fiscal side, which I think is, not going to provide a tailwind for a very long time, should not be discounted. And that's not even talking about the lag effect, from all this policy, which is still going, which is still, again, pushing against the economy. Which again is why I worry that there could be a policy mistake, that we could overshoot, because we haven't, felt the cumulative effect of everything that's happened, and we continue to, really take the oxygen, out of this market. And again, I think that's why, people need to exercise caution.
Let me ask you here about fixed income a bit more specifically before I let you go. We've seen a lot of volatility in equities overall. With all that uncertainty, and who knows what more uncertainty we'll all face together, would you say that now is a good time to get into the world of fixed income?
Yeah, it's a great time. At Thornburg, I think we have a number of products that, investors should really consider. So an investor over the last 10 years, maybe if they just, invented in FANG stocks and growth equity, that worked incredibly well. And now that those things worked very unwell, for the past, 6 months, 12 months. I think there is a danger in people saying, well, I can buy the dip, and, those things will continue to perform, over the next decade. If you think about market cycles, the fact that, things that work for a long time, generally that shifts to something else. And a lot of the things that I think people have not spent enough, attention on, whether that's fixed income, dividend stocks, international equity, even foreign currency exposure, I think those are the type of things that are very well likely to drive returns, certainly in the near term, but also possibly in the medium term and longer term. You should really be, refocusing on that, as opposed to, what worked for the last decade, and, that'll continue to be the same.
Why is it so important for investors, particularly now, to diversify their portfolios?
Well, 60/40 didn't work last year, and I don't think that's a reason to toss it out the window. If anything, now that you have real rates in fixed income, and, reasonably healthy spreads, that, getting 5 to 7% on your fixed income, allocation, relative to what pension funds model for their equity returns over time, which again is maybe more like 6 to 8, that differential is quite small, and much smaller relative to the past. I also think historic correlations where you see equity weakness and you see, bonds and fixed income perform well in that marketplace. I think that's likely to return, especially as we're making progress against inflation, and especially as we have this risk of a medium or hard landing coming up, even though the market's not focused on that today. Then in that environment, fixed income will perform very well and actually, create ballast in your portfolio. You look at any academic study and they talk about, healthy diversification and, exposure to a global market portfolio. I believe those trends continue to work over time and, should not be ignored.
And finally, for those looking to diversify their own portfolios, what are some of the best types of bonds that you would recommend they consider getting into?
Generally, we discourage, individual investors from purchasing bonds. The liquidity and the trading execution actually, it really pays to let professionals like Thornburg, manage a diversified portfolio for you. That said, I think one thing people can do themselves, instead of holding cash in a bank account, look at 3 month, 6 month, 12-month, T-bill exposure. In 2021, you got 0% for making that investment. Today you can get almost 5%. So you talk about, how much that's changed. You haven't had that opportunity since 2007, which was a long time ago. So I think, you want to be efficient with your cash as well as, having that global diversified portfolio that we talked about.
Absolutely. This is a great conversation. I'm very thankful that you're able to be on the show this morning, helping us get smarter together. That's Christian Hoffmann, portfolio manager at Thornburg Investment Management. Christian, thanks a lot.
Thank you.
You got it, man. All right, folks, coming up on the show, we will be bringing you the latest round of headlines on Meta's second round of layoffs and Toyota's aggressive push towards EVs. But first, we recently sat down with technical analyst Jay Woods to discuss current market conditions. Take a look.
So stocks right now are coming off of being in the green for a full month, and now we're starting to see that rally kind of dissipate. Is that the end of a bear market rally, in your opinion?
Yeah, that's the big question down here. I mean, we had such a rough 2022, left a bad taste in everyone's mouth, and now we had this massive and quick rotation into all the beaten down names. And from as a technician, we got to some key technical levels and we cleared them. So there are some really good signs that this is more than a bear market rally, that it is a sustainable rally. Does it keep going much higher? I don't think so, but chopping and going sideways for a while after the year we just had, not a bad start to the year, but it's not smooth sailing all the way through. We've got a lot of things to digest, but the start was fantastic. The speed at which it happened caught a lot of people off guard, and then technically, we never retested those October lows. We just broke above December highs. So we're in a nice little trading range, and we're going to watch Fed announcements, Fed talk, which we see all the time, to see which way we go. And then earnings season, Q1 so far has been good. So it's been okay.
Technically, what levels are you watching in the market?
Well, the 200-day moving average has been that line in the sand. In the S&P 500, it's about 3950, just under 4,000 now. And what we want to just see are a consistent level where we're making higher lows, and we've seen that. It doesn't just go to new highs like that, although the Dow, the transports, two big leading indicators here are on the verge of 52-week highs. So there are a lot of positive things, but I don't think people can expect to see what we saw in January continue. What we want to see is more of a broadening of the market, and not just the laggards lead, but 9, 10 of the 11 sectors continue to slowly and steadily rise, but it's no fun. We want to see some more action too. So, but technically, if we can trend above those moving averages, they start to turn up. These are great signs that the market broadening strength continues.
All right, my special thanks there to Jay Woods. And now let's get you caught up on some of the biggest stories that we are following for you at TheStreet this morning. First up, as the tech layoffs continue to mount across the industry, Meta is reportedly eyeing a second round. According to the Financial Times, the tech giant is looking to slash more workers as it continues its cost-cutting campaign under what CEO Mark Zuckerberg calls the year of efficiency. That's the quotes. The second round comes just shortly after Meta slashed 11,000 positions, or about 13% of its workforce in November. While the scope of the layoffs are unknown, the Financial Times reports that current employees are a bit confused about what budgets and headcounts are going to look like in the coming weeks, leading to a, quote, zero work environment, according to reports. While Meta has pulled back on spending in a number of different divisions, it continues to beef up its controversial metaverse efforts. Next up, as EV adoption continues to skyrocket, Toyota is looking to go all in. The automaker revealing a massive EV push this morning under its CEO-to-be, Koji Sato. Sato, who's expected to take the helm in April, introduced a new management team that will lead a total ramp-up of EVs with a specific focus on electrification. As part of this announcement, Sato promised a next-gen Lexus EV by the year 2026, and the company has taken heat in the past for its notoriously slow transition to full EVs after focusing on hybrid vehicles over the last few years. This aggressive push will help push Toyota towards its goal of reaching carbon neutrality by the year 2050. And finally, as earnings season rolls along, a handful of notable names are set to release quarterly results later on this week. Investors will be eagerly awaiting numbers from some of the biggest names on Wall Street, including Airbnb, Palantir, Roblox, Coca-Cola, DraftKings, many others. So far, roughly 70% of S&P 500 companies have reported fourth quarter earnings. And of these, 69% have posted better than expected results, which is solid, but still below the 5-year average of 77%. That's going to do it for The Street today here on this Monday edition of the show, the first one after vacation, and it feels so good. Thanks again to our special guest, Christian Hoffmann, portfolio manager at Thornburg Investment Management, for joining the show this morning. Stick with TheStreet.com for more on these and all of the major market stories that matter to you, and we will see you tomorrow.